what's motivating this is we received a comment on our YouTube page from a listener named Paul. He wanted us to talk about stock-based compensation, do a little segment on that. And this happens to be a subject that I've been looking into a fair bit recently, so I thought it was a great idea. I put together a couple of slides, and we will discuss what investors need to know about stock-based compensation. Okay, so first of all, what is stock-based compensation? So this is essentially supplementing employee and executive compensation with equity awards. Usually they're stock options or RSUs, restricted stock units. So essentially the way that it works is if you're a current or prospective employee of a company, they're trying to put together a good compensation package for you. Part of that package is essentially going to be stock grants that will vest in tranches over periods of several years. And what the idea of this is that it aligns the employee with the success of the company. The higher the stock price goes of the company, the more money the employee is going to make. So they're incentivized to essentially do a great job and be part of a great team. Companies love stock-based compensation because it can be treated as a non-cash cost. So in many cases, it accounts for a significant portion of employee compensation, yet there's no actual cash outflow, at least initially. And quite often companies and analysts just completely ignore it. So stock-based compensation, first of all, can be a very effective way of compensating your employees. And there are a lot of good things about it, but it also poses a lot of problems for investors. For example, a lot of companies, particularly in the software technology, mid-size, high-growth software companies, a lot of these companies substantially overused stock-based compensation, or SBC. Most companies, including analysts and some investors, treat SBC as a non-cash expense, and they completely ignore it. When they're determining adjusted earnings, they will ignore it and factor it out. When they're looking at cash flow, they won't consider it. However, excessive use of stock-based compensation can underestimate expenses. It can overstate earnings and cash flow, and it can also cause significant share dilution as well. In addition, some employees may start to demand more of their compensation in cash and less in stock if the share price returns don't meet their expectations. So this is certainly something that could be an issue for companies going forward, given share price returns have not been as good as they have been over the past decade. Now, stock-based compensation and how it should be treated that's open to wide debate. In one school, there are people, typically the companies, a lot of analysts, that just say you should ignore it. It's a non-cash expense. It doesn't go through the operating section of the cash flow statement, so you should just basically ignore it. On the other side of the fence, the other school are people who say this is a real expense and it needs to be considered just as any other cash-based expense. So one very famous investor who is part of the latter camp is Warren Buffett. And he's made many quotes on stock-based compensation in the past. I provided a couple of them here. One is it's become common for managers to tell their owners, the investors, to ignore certain expense items that are all too real. Stock-based compensation is the most egregious example. So what he's saying here is that this is a real expense. It can't be ignored. And it's in fact one of the most common ways that companies inflate their earnings is by ignoring stock-based compensation expense. He also went on to say Wall Street analysts often play their part in this charade too, parroting the phony compensation, ignoring earnings figures fed to them by management. And then he goes on to say this may be due to incompetence or just being part of the being part of the ignorance when it comes to stock-based compensation. But really what he's saying here is that you cannot ignore it. It is a major issue. So what we're going to do is we're going to take a look at a specific example of a company that uses stock-based compensation, a lot of it, and just see how this affects the presentation of earnings and some of the things that investors need to be made aware of. So the case study is going to be Palantir Technologies. This is a very well-known software technology company, SaaS, software as a service company, highly touted over the past couple of years, high growth, recurring revenue, basically all the things that have been attractive, that have attracted technology investors in general over the past several years. So taking a look at some select financials from Palantir from their fiscal 2021, financial report, you can see that revenue, about 1.5 billion in revenue for the year, adjusted income from operations, 473 million, and adjusted net income of $308 million. So all of this looks really good. I mean, you've got significant revenue, you've got high margins, you've got good profitability. But wait, these are figures, these are adjusted figures, adjusted income from operations, adjusted net income, and these ignore the stock-based compensation expense. So what do these figures look like when we include the stock-based compensation, as Warren Buffett, for example, would have us do? So off of revenues of 1.5 billion, after we include stock-based compensation expense, the company actually has income from operations of negative 411 million and a net loss of 520 million. So they went from significant positive profit margins, good profitability, to a substantial net loss and negative margins, purely because of the way that stock-based compensation is treated. And when we look at the company's stock-based compensation for the year, 780 million, almost 780 million, or 50% of the company's revenue in stock-based compensation expense. So that is by far the largest expense that this company has on their income statement. And in many cases, it's really being completely ignored. When you look at analyst reports on forecasted earnings, generally those are going to be ignored. When you look at the company's own calculation of adjusted net income or non-GAAP net income, generally this is going to be ignored. So what we did is we did a little bit of research. We analyzed a group of 50 high growth US technology companies, took a look at their stock-based compensation expense. So these are some of the fastest growing technology companies in the US market, many of them approaching profitability or approaching cash flow or having significant cash flow. But 70% of this group were paying over 10% of the revenue in the form of stock-based compensation. The average for this group was 16% of revenue. Now, you might look at this and say, well, 10% of revenue, that's not too bad. But if you have a 20 to 30% net profit margin, that's a substantial net profit margin, much higher than most industries could ever hope to have. So 10%, if you have a 20% net profit margin, after you're ignoring 10% of your expenses, then really like half of your expenses or half of your profit is essentially not real. But some companies use this much more aggressively. So the top 5 companies in the list, Snowflake being on this list, Palantir as well, from 30 to 56% of their revenue is stock-based compensation. Their expenses, stock-based compensation as a percentage of revenue. So that's a substantial factor when you're looking at these companies, and it's important to consider for a number of reasons. Now, the things you really have to consider as an investor when you're looking at this and how to treat stock-based compensation is the main thing that it's going to cause in terms of a cost to your company is stock dilution. So using stock-based compensation is really the same as issuing new shares to the market. There's a cost, right? You're delaying that cost. It's not a cash cost today, but there is still a cost. So you cannot ignore stock-based compensation completely as an expense. And this is especially true when companies make excessive use of it. Now, when we looked at that 50 company group, what we found is that a lot of the companies that were using it excessively were companies that didn't have much in terms of profitability and cash flow. When you're looking at the large companies, the Alphabets and Microsofts, it's much less of an issue. But when you're looking at the high growth, high revenue growth, low profitability, low cash flow, mid-size technology software companies, stock-based compensation is a major factor. And it's important to know how much a company is using when analyzing their profitability. Now, one thing I think that's also important to look out for is how are employees going to view their compensation if the share price performance of the company that they work for does not meet their expectations. So, for example, they join a company at the peak of the market. They've seen that this company has had returns, 20, 30%, 50% share gains per year over the last several years. This hasn't been uncommon in the software technology space. They leverage a significant portion of their compensation to what they believe is the future share price potential of their company. And now we're in a situation where many of these companies are actually down 20, 30, 50% or more. So looking in the future, I think that it's very likely that employees, unless these companies start skyrocketing again in share price, it's very likely that many employees are going to go to their employers and demand more of their compensation in cash as opposed to stock. So that'll be something to keep an eye out for. And this can be a very difficult situation for companies that aren't generating a lot of cash flow because they simply won't have the money to pay it. So it's something that we definitely need to consider when looking at a company, not something that we want to just ignore.